Welcome back to the Rate of Change with York Wealth Management. As advisors to some of the wealthiest families in the country, the Rate of Change is a podcast designed to help you in the pursuit of building long-term wealth through the insights of some of the brightest minds in asset management. I'm your host, Murdoch, and in today's podcast, we're joined by Eric Chan, co-founder and group managing director of Aura Group. Starting out in law, Eric went on to co-build Aura into Asia Pacific leading multi-strategy investment house, spanning venture capital, private equity, and private credit. Eric's main responsibility is overseeing the venture fund, essentially hunting for the next unicorn, the next company that's going to go 10x in Australia. How they structured it is a seed stage vehicle, conditionally registered as an ESVCLP, where investors commit capital via stage calls, gain tax benefits once fully registered, and back founders across Australia and Southeast Asia. A standout holding they have had previously is Haast, HAAST, an AI compliance platform currently used by Telstra, Zurich. As Eric points out, the best measure of AI success and whether or not it's doing its job properly is cost savings. So Haast has reduced compliance costs by roughly 60%, cut review times by 80%, and scaled rapidly from a number raising over the years. I'll let him dig into that. On the other side, since they do have the capital call structure, the other issue a lot of clients discuss is what do I do while I'm waiting? So they have available the private credit income fund, an evergreen wholesale fund that's delivered greater than or roughly 9% since 2017 by financing non-bank lenders with short duration loans, first loss protection, monthly liquidity. It also offers stable income and strong risk controls. One thing I really liked, which we get into, is the logic that if hypothetically you have $1 million in a private income fund over a 4-year period, if that's averaging 10%, you're looking at roughly greater than a $400,000 income from that fund. You can technically use the income from the fund to invest in more growth-based businesses like the venture capital strategy, right? Whilst protecting the capital, which I find a very interesting strategy, which Eric's going to dig into. Eric also explains why venture capital must be run as a portfolio, how to balance write-offs against fund returners, the cyclical nature of venture capital markets, and where they're hunting for the next unicorn. Specifically, their main attention right now is on AI businesses and how to spot an AI business that's actually solving a problem instead of a legacy business that goes, hey, AI is the new flavor of the month. We need to tack on the word AI into some part of the business when it's not really an AI business. So before we get into the conversation, please remember this ROCast is made for entertainment purposes only. I encourage you to listen to the disclaimer at the end of the ROCast and keep your feedback coming. You can reach me at mgatti@ywm.com.au. So with that being said, I hope you enjoyed this conversation as much as I did. So sit back, relax, and enjoy it. Eric Chan, Aura Group. Welcome to the Rate of Change with York Wealth Management.
Thanks for having me.
Good to have you on, Eric. Always good to see you. Great lunch we had the other day. That was fantastic. We could sit here and talk about that all the time, but why don't we begin like we always do? And why don't you tell everyone a little bit about, who is Eric? How did you get into finance and a bit about yourself?
Yeah, sure. So I was born in Hong Kong, came to Australia when I was pretty young, about 5 years old, with my mum and my sisters. I did my primary higher education in Australia. Throughout that kind of education process, my education process, I actually ran a couple of businesses, like little startups, as you want to call them now, but back then it was just little side hustles. I actually did that with my co-founder, my current co-founder. So we did everything from selling secondhand books on eBay to building computers for people. So we always kind of had this entrepreneurial spirit. As we finished university, I kind of went and became a lawyer. I, I worked out pretty quickly that I wasn't a very good lawyer. I cared everything about the deal, but nothing about the legals. um, so there was a pivotal moment I remember in my life when I decided that it was time to move on. Like I've learned everything that I wanted to learn, and it was time to move on. And that moment was when I can't remember. It was like maybe 1, 2 a.m. in the morning. We were on a transaction, and I was working for probably one of the best banking and finance lawyers or partners in town. And I remember turning around and I just saw my partner just slaving away, drafting documents at 2 a.m. in the morning. And I just thought, if I'm the best in town and I'm doing that at 2 a.m., I don't think that's what I want to do for the rest of my life. So at that point, I decided to leave and set up my own business.
Yeah, I said it once, I said it 1,000 times. I love in finance, everyone has a roundabout way about how they got there. And it's the number of people that get into this game, they go, "Hey, I want to be in finance." They end up doing a different thing, develop a phenomenal skill set and something completely random, and then bring it back into finance. But wouldn't you agree that like things like law, accounting, sales, or just sales and marketing, I spoke to a bloke the other day who had a who was pretty much like a computer engineer. Right, it's just fascinating. These particular these 4 or 5 main skill sets, right, are so important as a foundation, and then you bring it into finance, into what also like a deal or be it property or anything specific. And people that are coming with finance that don't have that, or I actually find they're missing out. You know what I mean? Like wouldn't you agree? Like the majority of what we do is predominantly contract centric, or numbers centric, or AI centric. You know what I mean? Like it's invaluable
Yeah,
having a law, mate. I wish I had a law background. I think I did one subject at Sydney Uni. I think I just passed with 66%. I'm like, what the hell am I doing? I'm not doing a law subject again. And then I knocked over a Master of Commerce, and my main thing was all strategy. Playing chess. Like seeing the big picture. But mate, having a law background with contracts, even though 2 a.m. would have sucked, but how important is that when you're looking at deals and everything now?
absolutely. Like I think it gave me the infrastructure to do a lot of things that I did today. Like, a lot of people when they're doing investments, that's new to the game. They don't realize actually how meaningful it is if you kind of understood the legals or the or the accounting side of the transaction, because it just allowed you to actually understand, or call bullshit sometimes on negotiations, or when you're running your own due diligence, or you managing your service providers. I think that infrastructure allows you to be a lot more effective in deals. Um, but also when we started the business, we were pretty young, right? I was 26 years old. Didn't have a brand, didn't have a track record, didn't have any money, which meant that I kind of had to do a lot of things myself. And having that legal background allowed me to really push out the use of engaging lawyers right to the end. Right. And even then I was able to manage how much time that they got involved, and therefore reduce my costs really early in the piece, because we just didn't have any money to spend on unnecessary things. Engaging legals and lawyers is important, but there are certain parts of it where you know as an ex lawyer that you can shave time off.
Yeah, devil's in the details, I say. But yeah, look, one entrepreneur to another, mate. The legals, if you don't understand it, you can end up spending a lot of money.
Yeah, it's like I always say, it's like engaging a builder. Like if you don't understand how building works, like you could end up spending a lot of money on variations.
A lot of money. It's like, I got a great idea. That's fantastic. Here's the boilerplate. And then you change it
Yeah,
6 times. Like, why did my bill just go from, 40 grand to 200 grand? Trying to make
exactly.
money here. But if you look again, if you don't, you need a good lawyer. Right,
Yeah.
but it's all scale and everything like that. So you mentioned, so just while we're on the topic, because this is fascinating on the entrepreneurial side. So when you were growing this stuff, you didn't need the legal capacity, right? And you're building this business. So what did you find was the easiest and the hardest thing about starting Aura and Aura Group?
Yeah, so when we started the business, it was actually back in 2009. So my co-founder and I, we actually came out on our own accord or left our businesses on our own accord. So it was during the GFC, so I was super bored because there was no transaction as a lawyer. At that time, I was in private equity law. My co-founder actually got made redundant because it was at Everest Babcock in Brown, which was one of the most spectacular blow-ups in Australia. He came out and he was kind of doing his own thing. I was doing my own thing. And then eventually we just said, why don't we just do something together? And the truth was no business plan was in place. We just said we want to do something. But what did we want to do? We wanted to get into early stage businesses, but how do we do that if we had no money? Then we said, well, the only way we can do it is invest other people's money, right? Which, people call it funds management eventually. The easiest part for us, I think, was actually at that time deciding that we wanted to basically give it a crack and do something on our own, because it was during the GFC anyway. So it was, he was out of a job at that particular point in time. I was bored, and we just always knew with the skill set that we and the experience that we had, we can always go back to a job. So actually taking the punt, as hard as a lot of people thought it was, for us it was actually relatively easy. The hard part was everything else, which was, we even though we wanted to get into investments, we wanted to get into an area where it was completely niche, which was venture capital, right? And venture capital wasn't even a terminology in Australia back in 2009, 2010. We also, as I was saying before, we had no brand, no track record. We were 26, 27 at the time, but we looked like we were 16 and 17. And it was just like, no one's going to give us any money. It was impossible to raise money. So with the entrepreneurship that we had, we started off actually as a corporate advisory business, because what it basically that was we leverage off the skill sets that we had to advise other early stage businesses, whether it's their business plans to helping them raise the next round of capital. So for us, it was definitely the raising capital bit, and actually just getting set up was definitely the hardest, but coming out and deciding to do it wasn't actually that.
Yeah. It's fascinating what you just said there. So if entrepreneurs out there listening, right, you can't just go okay, let me rephrase that. Doesn't matter what deal it is, the single most important, be it property, be it venture capital or anything, wouldn't you agree? The most important thing is having a good deal, right? But if you don't have the ability to raise the money and bank that deal for the deposit, right, the next best thing is you need to develop a reputation in the market for understanding what a good deal is and people to understand that. So how good is it when you have a consultancy business, which is generating cash flow, which is number one, the hardest part to pay for everything else. Then you build up your reputation. And then along the way, you are looking for a good deal. And as friends of mine say, like say you're looking at 200 deals, you're not looking at 200 deals. You're not saying no to every single deal. You want to say yes. You want to say yes to the right deal that's right for you, right? And only maybe one or two or three deals that year or the next 2 years may be a yes, but you need to see 200-300 transactions to say yes, because you want to say yes to a transaction, right?
Yep.
And then wouldn't you agree that, with the cash flow and everything, you're building up your reputation. And then when one deal lands, how much easier is it to close that transaction, when you're in the game?
Look, I think, the one thing I learned over the last 15 years is people or fund managers always underestimate what it means to run a funds management business or build a funds management business. You always have exceptional investors that come out of big or small firms. They've got great track record, great performance, and they come out and they just think, I can do this on my own. I don't need the infrastructure because there's no value in it. And it's all about me and my ability to invest, because at the end of the day, people are backing my performance and not the infrastructure around me. But every 10 out of 10 times, it would be they realize that, I didn't realize how expensive it is to build this infrastructure, and two, how difficult it is for people to actually invest, to actually raise money, right? Because sometimes even if you have the track record, historically in other funds, it doesn't mean that people are willing to invest into your new product, your new fund, because no one wants to be the first investment or the first investor in the door. That was, we always say raising the first 10 million in any fund is always the hardest. But for us, not only was that difficult, it was also, well, how do you create a sustainable business? Like being a fund manager isn't just building a strategy, it's actually building a business. And I think that's a big distinction that a lot of people don't realize until they really get stuck into it. And so if you want to build a business, you know, it doesn't start with, you don't start at 10, you start at zero. And when you start at zero, you need cash flow. Or you can raise, if we were a tech business, maybe we would have raised a whole heap of money, but we weren't. And therefore, we had to basically just be entrepreneurial and kind of hustle our way through at the beginning and generate the cash flow outside of not necessarily what we thought was our core business. Um, but I think what you need to do very quickly is realize over time what is not your core and what is your core, and kind of reduce the non-core part as quickly as possible. Because the flip side of being entrepreneurial is actually everything is super interesting. Everything could make money, and you could just get pulled into 100 directions, and you'll try to do everything, right? Because everything sounds interesting. So to balance that, it's really, how do I then stop doing the corporate advisory stuff? Because yes, it gave me the nice sugar hits of revenue, but it wasn't what's going to build my sustainable business that's going to build the highest terminal value in this business over time. Um, and basically be willing to say no to that cash flow or that revenue hit as you kind of get bigger. And you will be able to, but you just have to learn to say no at some point.
Yeah, it's a lesson that everyone needs to learn, but you can't have A without having B. So with the fund right now, right? What is the fund? What's the philosophy? Like where did you land as you called it? What is your core now?
Yeah, so I run our venture capital strategy inside at Aura, which was actually our first strategy within the group. But maybe to give you some history on how we got here, because right now we don't just do venture. We do venture capital, we do private equity, and we do alternative credit. But early in the game, we kind of had a philosophy in the way that we invested, which was we believe that in order to invest in Australia, in venture capital in Australia, you kind of have to play a very different game than any other investor around the world. So as to you got to have to play the field a little bit. In Australia, while it's a great country, you have a lot of disadvantages. We're far from everyone. We generally have small markets in most industries, and you also have less access to capital than anyone else. Not only because it was nascent, it was just a small market. What that meant was that Australia has developed this very capital efficient DNA. And if you look at some historical data, like Australia has been able to deliver more unicorns than any other region per dollar invested, right? But when you look at the absolute number of billion dollar businesses that have come out of Australia, it's not that many when you compare to the rest of the world. So our philosophy is that, if you're chasing billion-dollar outcomes in your portfolio companies, and as your only way to deliver the returns that you need for your fund, then your probability of success is relatively low just mathematically, right? So the way we're kind of thinking about it is, well, how do I generate our venture style returns when those companies don't have to reach $1 billion outcomes? And the only other way is you've got to get in earlier, right? And which is why we focus so much on seed. By focusing on seed investing, it allows ourselves to focus to get in at the right valuation, get the right ownerships in the businesses, so as to be able to return our fund even before it gets to the $1 billion outcome. So what that meant was for us was in VC, we wanted to basically continuously build muscle around a stage of investing. We also took the view that you can't actually invest. You can't be a specialist in terms of a particular industry or sector in Australia, because we didn't feel like the market was deep enough at that time or even now. But we do believe that investing, it is a muscle that you get better at as you kind of do it, and which is why we wanted to focus on a stage of investing as opposed to an industry or sector. But what that kind of translated to was, well, actually, we don't think that you can actually effectively deploy hundreds of $1 million in seed stage investing in Australia at that time.
Arguably, I think probably 75 to 100 mil is probably the most effective fund size for seed stage in Australia today, but definitely not back then. Even definitely not hundreds of $1 million now, or definitely not back then either. So what we said, okay, so if we wanted to stay true to our philosophy in being, I guess, disciplined and high conviction in the way we invest, that's fine. But then it means that we're only managing 20, 30, $50 million at a time for each fund. But how do you create a sustainable business that way? And so our decision was, well, rather than kind of just do bigger funds and kind of compromise the way we wanted to invest, we said, well, why don't we expand into other strategies so as to we can continue to be patient in the strategy that we run and be disciplined in the strategies that we run, while kind of build our overall business by introducing more strategies into the fold. And as a result, we kind of went into then private credit and then eventually private equity. But I think one thing that kind of applies across our business is, regardless of what the strategy is, we generally believe that you kind of need to solve white space, right? So, right now we're in the process of, the business is in the process of launching a new real estate credit fund, as an example, with a great partner that we're bringing on board. And the first question was, does Australia really need another real estate credit fund, right? Like, there's so many of them out there. But what we've discovered, or what we worked out with this partner, was actually there is white space in real estate private lending, and it's in this sort of $1 to $20 million construction space where the big guys or the successful guys don't really want to fund because it's getting too big, and the smaller guys don't have the skills and capabilities to actually do these loans, right? And as a result, there's borrower demand, and the risk-adjusted returns also stacks up in this space. So kind of going back to your question, then, it's today so the way that we've kind of I guess grown our business was, I think we've actually eventually developed not necessarily just a funds management business, but a fund platform whereby we can continuously grow or develop new strategies within the platform that shares a middle and back office infrastructure. And it's almost the same as the way I look at VC, funny enough, which is it's about people. I want to find, like I do in VC, I want to find the best founders to back. In this case, I want to find the best portfolio managers to back and then give them the infrastructure to get them successful.
No, 100%. Completely agree. It's interesting you say that, because if you look at the history of fund managers, like how many fund managers have fallen over?
Nope.
And what's interesting about when you go back and look at the fund managers that may have fallen over, they're normally just been a single asset fund manager. They normally just only do one particular thing. And that's fantastic when the market's ripping and, everything's in their favor. But when you get a particular winter or a tough time, and then you get funds being pulled out, it's very challenging for them. But where's that money go? The money doesn't vanish out of the market.
To me, there is a unspoken truth about funds management that doesn't get talked about a lot, which I think it's obvious, but it just doesn't get talked about a lot, which is there's a natural conflict between growing a funds management business and performing or staying true to your strategy. Because growing your funds management business means just increasing the amount of funds under management you have in that strategy. But there's a certain inflection point in your strategy where there's too much capital, and then as a result, you have to change the way you invest, right? Or, for example, as a fund gets bigger, you might have to do bigger deals because the smaller deals no longer make sense, because you can't actually manage as many deals if you're only still running small deals. Otherwise you're kind of sitting on too much cash and you're causing a cash drag in your fund. And it's interesting because we're starting to see this play out now across the industry, not only across the US, but also in Australia, where single asset managers are now expanding into other asset classes or expanding their strategy. we're seeing, like, for example, Lightspeed in the US following some of the other large players like your ACC and Zs of the world, where they're no longer. If you kind of look at them, they've now registered as I think an ROA, which basically allows them to unlock the type of deals that they can do. Where in the past it was venture capital, but now they can do secondaries, they can do listed equities, they can do debt, they can do acquisition, buyouts, etc. Now, if you kind of look at that, like, they're no longer just a pure play VC, and they've kind of moved into multi-asset. And we're seeing that in Australia. Like, if you look at the most recent Airwallex deal, like, some of the funds that have gone into that deal, like, you can't honestly say that's a venture capital investment. It was a Series F. It was I think it was a 10 bill valuation. And if you're doing a VC deal and you're trying to get a 10x return on that, like, it means Airwallex is going to have to eventually be 100 billion, right? I don't necessarily think that it could be, but I don't necessarily think that that's the chase people are going after. So I feel like the mindset and the strategy has shifted, and that's partly driven by that conflict of the size of capital that the funds under management that you grow. So when we've kind of thought about that conflict, or kind of how it's played out, is how do you solve for that? Which is, well, in order to do that, we could have a platform where we could house a bunch of managers that allows them to be disciplined on the size of capital that they raise, so as to be most efficient and effective for their strategy without overgrowing, but yet being able to be a sustainable business, because you then become a house of strategies, right? That can leverage off the infrastructure and the cost base across the group. And but if you were on a single strategy, there's no way you can do that and be a sustainable business. Which is why, unfortunately, in VC in Australia, what I think we're gonna start seeing is we're gonna see a bit of contraction in the market, because a lot of the pure play VCs in the market that came about maybe 5-7 years ago, their funds are probably subscale in terms of being able to run a business, where they're probably managing sub 50 million. And in this particular market, they're gonna struggle to probably raise the next fund. And if they don't, how do you even if they're on a 2% on 50 mil, how do you actually maintain a business on 100 grand a year in terms of management fees?
Yeah, it makes a lot of sense. So in summary, to run a good business, you need multiple strategies, because as you mentioned, the venture capital is a long-term strategy that takes time. The equity side, can become shorter, but you need cash flow through the door, right? And then Australia's turned into a bridging loan economy, and there's a demand for it, right? There is demand for private credit, because why? The banks aren't lending, right? So the three main strategies you have are private credit, venture capital, and the equities. Yep. So with the why don't we just do the private credit first? So the private credit, what return would a client expect to be in there, and what are the mechanics behind that fund?
Yeah, so our private credit income fund, that's going into its 8th year anniversary, and that's been averaging about 9.5% per annum over that entire period since inception. It's got monthly liquidity, and it pays distributions monthly. It prioritizes capital preservation over alpha returns, and basically the strategy is to provide, in simple terms, warehouse lending to lenders, such that it allows us to scale and create diversification across the book through multiple lenders and multiple asset classes. So if you look at underlying loans across this strategy, there will be tens of thousands of loans in there, which provides real diversification. These are all corporate loans or SME loans in most cases, and it doesn't do personal lending. It doesn't have personal lending exposure in it. That fund is now rated by multiple agencies. Is on platform. It's an evergreen fund, and it's just allowed investors to leverage off the credit wave over the last couple of years. But it's one of the few credit strategies that's been around for about 8 years in Australia.
How much is in the fund now?
In excess of $500 million.
Yeah, right. And the private equity strategy?
So private equity was probably one of our latest strategies, although it's probably about 7-8 years ago. It's at the moment we do predominantly SPVs. So we don't have a blind pool fund, but that's probably the next chapter for us. Across the SPVs, we're kind of focused around sort of sub 100 mil EV businesses.
What is
Opportunity.
for people that aren't familiar? What's an EV business?
So enterprise value. So the market cap or the market value of the business, and these businesses generally is a situation where you've got a set of founders that are looking at taking some money off the table, not necessarily want to walk out the door today, and there's still a lot of growth trajectory to go. And we kind of come in, we help them take some money off the table, maybe fund a little bit more for growth, and then with the plan to exit over the next sort of 3 to 5 year period. And it's industry agnostic. One thing, and so we've invested across Asia Pacific, but one particular strategy that we're looking at is predominantly across Southeast Asia. And in simple terms, what we're looking at is almost like a time machine kind of strategy, which is there's certain industries or certain models that have played out really well in across certain regions, which are similar to Southeast Asia. So, for example, China is a big one. All right. So there's certain models or industries that have played out really well in China, and then we look across Southeast Asia where there's which regions have similarities with China across that industry, and then we look at where is the market at in terms of maturity in those industries and in those sectors, and we look at that from both capital kind of that's been invested in this space, but also liquidity that's happening in this space. And we look at kind of, what could have the tailwinds that those comparable countries have received over the next few years. And we kind of look at every opportunity or every business in that space and then kind of make our bet in what we think is the market leader at that time that has room to grow. The other thing that we kind of look for outside of just founders maybe just looking to take a little bit of money off the table or looking for some growth capital, it's also possibly a management buyout situation where the people that's running the business is really the management team, but the shareholders that own the business, the original founders that own the business that's no longer involved, own most of the equity, and then we kind of come in and do a leverage buyout, a management buyout with the team. So unlike traditional private equity, we're not stepping in, taking over operations and trying to rip out cost synergies. It's really about growth capital. And it's really about working with our founders in those businesses to grow the business, or founders on management teams to grow the business.
So that's via an SPV structure. So essentially every single deal is its own standalone transaction. So how does the venture capital fund work, and why is that different? Because it sounds like, well, venture capital is right, seed-based, investing, right? Isn't that this?
Yeah.
Like, I'm just saying, to a layperson having a listen, they're like, doesn't venture capital just sound like equity investing? What's the difference, and how's the venture capital fund operate?
Yeah, look, let's talk about the asset classes. So if you simply put, venture capital is much earlier in terms of the business's life cycle than private equity, right? And even in venture, you separate it from kind of seed to post-seed, and post-seed will be like your Series A, Series B, Series C onwards. And the way that we kind of define it, because we don't, even though we say we're a seed stage investor, we don't define it based on a naming convention. It's not about the round that you raise. For us, it's about has the business reached product market fit? And product market fit could be defined as does the business or the founders are they solving a problem in a way that has a material impact to the way that the problem is currently solved, and is it they're solving a problem that's meaningful enough that people and material enough that customers are willing to pay for it, right? And you're just generally seeing, signs that we normally see is just generally this love for the product that the customers have, and that's kind of sort of signs of product market fit in very simple terms. And in that particular case, it's not like your late stage investing, even in late stage VC, and definitely not private equity, where you've got a set of numbers. It's almost like partly a spreadsheet exercise where you already know what the defined metrics are. You're running spreadsheets and you're kind of doing analysis of the business. It's more predominantly on who the founder is, basically building conviction on the founder, building conviction around the thesis in the market and the problem that they're solving. How it should be solved, why it should be solved, and that in the way that they see the world, about how that problem should be solved over time. But then also having a product and having signs of engagement on the product. So if you're going to distinguish VC and private equity, then private equity is a lot later stage. So the businesses already have product in market. They basically have customers, and it's really about, okay, what is the next stage of growth? How do you then go from what they are now to expand, whether in product, expand into regions, or to take more market share in the business, or in across the industry or the sector? Generally, these businesses on private equity side are profitable, right? Whereas, in the seed stage side, they may not even have revenue, or they're just on the brink of revenue. And so very different deal cycles. So naturally, if you kind of think about it, like, there's one thing that I think in the nascent market, when we first started in VC, a lot of people didn't understand, or LPs didn't understand, which was failure rates are normal. Like, businesses not working or going bust is normal in venture capital, right? And which is why it's so important that you have to run a portfolio. So when we first started in venture capital, because the market was so nascent, it was so difficult to raise money, it was almost a means to an end where we started off doing SPVs. Yeah. But we very quickly pivoted away from SPVs into a blind pool fund, or into a fund structure, whereby, because we just knew that you have to build a portfolio, you have to run venture as a portfolio. Whereas you don't have that type of failure risk in private equity, and therefore you can run it as SPVs for as long as you want. The benefit of running SPVs is it gives investors that certainty in terms of, I know exactly what I'm investing in. Half the time is actually I'm kind of backing the business as much as I am backing the fund manager, right? Because it almost allows them to pick. Now there's this up and rising syndication model that's coming out in Australia, and I think it could work, but I think when they start managing LP expectations, that's where it becomes difficult. But that's the distinction at the moment.
Yes, so Eric, with the VC fund and the SPV, how is it structured? So if we're investing with Aura in this in these types of businesses, how's it structured? Do we just, I don't know, does an investor just give you $500,000 and then the money's in there for 5-10 years? Because the life cycle of some of these businesses can take a very long time. Like, how do you structure the transaction? Because we've had a conversation before that it's done a bit differently, but do you want to explain how that all works, please?
Yeah, sure. So on the venture capital side, so first of all, we don't do SPVs anymore. Like, that was something that we did at the beginning when the market was still nascent, but we generally believe that venture capital has to be run as portfolios. So we don't do SPVs in VC anymore. We do in private equity, but not VC. And the fund structures that we run in Australia, it's what they call the ESVCLP, or the early stage venture capital limited partnerships. And what that is, it's basically a partnership structure whereby our registration has been, if approved by the government, it basically provides certain tax incentives for our investors or our LPs. And these incentives are things like, any returns, whether it's income or capital that comes out, it's tax-free for the investor. There's up to a 10% tax offset for our investors for deployed capital from their capital calls. And I think there's a pass-through in franking credits as well.
What's a capital call? You said capital call. What is that?
Yeah, so the way that the fund works is it's a capital call structure, meaning that we call capital as when we need it or as when we find opportunities to invest in the fund. So let's just say, an investor wants to invest $1 million, right? So they commit $1 million with us up front. And basically, they're investing off the back of our strategy and our track record. So we take that commitment. Typically, on day one, they might fund 5% of that commitment. So they give us 50 grand from day one when we do the first close. And then thereafter, as we find opportunities, we'll make capital calls, generally between 5 to 10% capital calls. So progressively, we will, over the next sort of 3 to 4 years, call this capital until it's fully called. And what happens is we combine, in terms of our strategy, we do our first check investments and we do our follow-on investments in the same fund. So what that means is we'll build a portfolio of assets or companies. And for the ones that we think are potential outliers, we'll continuously to follow on their future round of capital raisings. So we combine those two exposures together into one fund. So, for the first probably 2 to 3 years, we'll probably call more of the money faster because we're building out the portfolio. And then we will reserve an amount for follow-on investments. And that reserve will get called based on, it's a little bit less predictable because it just depends on when the company is raising the next round and we want to participate. One thing that we've leaned into is one of the benefits of a capital call structure is you're not sitting on cash, right? So you don't have the pressure to deploy capital. But I think there's a natural pressure to deploy capital when LPs are saying, from LPs where if they've committed to something, mentally they've kind of set it aside, say they want to deploy it, right? And there's this general, well, why aren't you, if you're slowing calling capital.
Let's call it what it is. It's called cash burn. And if cash is sitting in their bank account not being used, an investor goes, well, I will pull that money out and stick it somewhere else, or it's costing me money. What's going on? Cash burn.
Correct. So there's this general conflict between, well, I want to be able to, if I have to call the capital faster in order to satisfy my LP's sort of expectation, then I need to find somewhere to stick it. So for us, we don't think that that's right. We think that we should only call it when we find the right deal, and which is why, actually, if you look at our last fund, our 2022 vintage, we actually did our first close in 2020. So we did our first close on that fund in 2020, and we started deploying in 2020. But actually, between 2020 and 2021, we actually didn't make we actually didn't call a lot of capital because we didn't make a lot of investment. Because during a period of time, we just thought the market was too frothy. We kept getting priced down on valuation, and we were just very slow in deploying. And that was us leaning into the ability to do that because there's a capital call structure. But at the same time, we copped a lot of criticism from investors in terms of how come you're not deploying? How come you're not calling capital where every other manager is deploying? And I've got this money set aside for you that's not really earning any money. Like, what do I do with it? But if I kind of look back today, like it was probably the best thing that we ever did, right? Just being disciplined in the way that we deployed. So if you look at our 2022 fund, even though it was first closed in 2020, and technically it's kind of 4.5 years now, our weighted average in terms of time of us holding that capital from investors based on the capital cost has only been about 2.5 years. Now,
how many investments in that fund?
So that one's got 12 at the moment.
That's got 12.
Yeah,
I want to dig into this a bit, right? Because I've known you guys for a long time. A colleague that used to be with you guys used to go to school with. So I've known Aura for a long time, right? From an investor and advisor's perspective, where we look after clients' capital, we might allocate 10, 15% of a client's portfolio to these investments, right? Early on for me, a capital call structure is very challenging, right, to go into. Like when you're an advisor allocating money. If you're a private investor, really simple, easy, because you can account for it. Yep. Because how can I tell the client they're going to stick 100 grand into something and it may get called down if and when it does? Because the other issue is if I'm, say, hypothetically using your private credit fund or someone else's, that money might be stuck in there quarterly, half yearly, but you need that money out within a time frame. We get in in trouble. And the other thing with an investor is we're doing an asset allocation to a particular strategy. The money's sitting there. They know it's sitting there for 4 years, but if it's not, the money's actually sitting somewhere else. It doesn't make sense. So we actually discussed at lunch a solution to this problem that you currently have, that you're starting to discuss with other financial advisors about how to restructure the venture capital fund with the use of private credit. Do you just want to walk through,
Yeah.
how you've gone about solving that particular problem?
Yeah. So
It's quite
then,
important. It's quite important because I love what you do. We love the upside. We'll get into the deals. The deals are fun. Like your back channel, it's been magnificent. But solving this particular part, which people aren't familiar with, is very important to get their head around how best to work with you regarding the capital calls.
yeah, it is. It is a structural issue that has been a barrier for us in the past. So how we solved it initially was actually similar to exactly what you said. Investors are like, well, I've got this cash sitting aside. On one hand, I want certainty that I'll be able to fund your capital calls if you call for it. But at the same time, I don't want it just sitting in cash and not earn any money from it. All right. So what a lot of our investors have done, and this is the benefit of us being multi-asset, where we've got venture capital and we also got private credit, is they basically park the committed capital. Let's just say they committed $1 million. They park the $1 million into our credit fund, which has a monthly liquidity profile. Because because it's under the same tent, we kind of obviously have insights into when we're likely to be calling capital, right? And we know what the redemption windows is for the private credit fund. So it's a lot easier for us to actually manage a redemption for one fund to move into the next fund because we just understand the processes behind it. Now, you could obviously do it with a third-party credit fund, and someone could do it themselves. But I think where they could put the money into another credit fund that's with a completely different manager, but it's just the because without the insights behind the operations of the two funds and the insights in terms of the timing of the capital calls, etc., it is very hard to match it as well as we would by owning the two funds in the same group. So that's how we have currently solved for it. I think in the future, one of the things that we're considering is actually, does it make sense to do a feeder fund? All right, basically it's a feeder fund that has the ability to invest into both funds. But the intention is whatever you invest into the feeder fund, that is 100% commitment into the venture fund. But while it hasn't been called, we will invest into the credit fund and move it across. That way, you will be able to get distributions when you're basically making a venture capital investment, right, on a monthly basis to a certain level. And you don't have to worry about sort of like the cash drag on your capital just sitting in the bank account doing nothing for the period that it's not being called. And still at the same time, we have all the benefits of actually, having the capital call structure in the venture capital side and not impacting performance.
Yeah, it's a very important topic to discuss because, I find with these podcasts, you can read through all the information, get your head around it, right? But then the same one thing with every single fund manager pops up, the one problem they have, and I found with Aura, it's that capital call because you do great work, the deals you do are great, the team's fantastic, right? But that capital call, not knowing when the money's going to hit. But I've been chatting to another one of our colleagues that oversees a number of fund managers. He's fantastic, and how myself personally and him, we've been running money is very similar to what you're discussing now for clients. But we've actually been doing the same thing where instead of we don't have a credit fund, right? But we've been using, say, your credit fund or other people's credit funds, and that's the defensive part of the portfolio. The defensive part of the portfolio generates income, and then we're taking that income and then going offense.
Yep.
So we've been doing that for the past handful of years now, and it's been fantastic because guess what? You don't get as volatile choppiness. You get very little risk on the original equity, right? So capital drawdowns are less. When people psychologically a lot more comfortable, because when people are taking risk on money which they made from a profit, guess what? Right?
Yep.
They only potentially, if the market goes down on the profit piece, they don't feel as comfortable as, say, you're losing a 20% drawdown on a $3 million asset, which you spent your entire life building. Right?
Yep.
So I'm a really big fan of the solution which you've come up with, but it's inside a fund structure. So we're just doing this based on, a normal portfolio, right? Having these, alternative assets generating a large amount of income, then taking the income and allocating it to strategies like yourself. But I just find it very interesting that you're now, looking at it from internally. Or the other thing which you were discussing at lunch is that you're helping financial advisory firms create their own managed fund, so to speak, or their own particular vehicle where the clients can go in, where there is an income component, and then the income's used to essentially assist and help with the capital calls, as they come about. Right? Have I got that correct? Because
Yeah, that's right. And
it's brilliant. It solves a lot of problems.
yeah, and the way, and at a very high level forecasting, what we've kind of worked out is about 40%. So you could potentially cover your commitment in the venture fund, which equates to about 40% of the distributions of the way that you can ensure that the distributions out of your credit fund investments matches your venture capital exposure is it's circa 40%. So let me just explain how that works. So let's just say hypothetically you committed $1 million into invested into the credit fund. Based on the average yield over the last 8 years, call it, and based on the timing of capital calls historically that we've done, what we've worked out is you'll deliver the distribution that comes out will allow you to invest about 400 grand into the venture fund and be purely funded by the distributions from the credit fund.
Love it. How good's that strategy?
Yeah.
And then it's all compounding. It's great.
And it's tax-free on the venture side.
Yeah. And then you're taking the income from an asset which you're not risking to take the income to then have a nudge on something that may go nuts.
Correct.
But okay, let's talk about risk, all right? So you've been doing this for a long time, right? What do you reckon the true numbers are on? Sorry, true is the wrong word. What are the numbers based on deals that have been successful compared to the ones that have failed? And the reason for anyone listening why I'm discussing in this way instead of what are the percentage returns, right, is in the VC game, everyone knows that we're at the risky end of, but there's a lot of upside. But deals, businesses can fall over, right? And we account for that, right? So what do you reckon how many deals have you done, and what has been successful, and what has gone by the wayside? Like, what do you reckon the actual statistics are? Because that's the only way I can really gauge a venture capital strategy.
Yeah. So the rule of thumb in the market, and I'll go into what our data is. So the rule of thumb in the market is you expect a third of your portfolio to go to zero. You expect a third of your portfolio to do kind of 1 to 2x, and then you expect a third of your portfolio to do kind of 2x plus. Yeah. What we've seen is because we take a more high conviction approach, we've made 25 investments in VC over the last 13 years. 4 of those have gone to zero. We've had about three or 4 of those that have done 5x plus, right? And then everything else is in between, kind of probably call that a third is kind of in between 1 to 3x, and then everything else is in between. And which is very different to the third. But ultimately, I think the message would be like failures in venture portfolios, it's expected. Like you are expecting that businesses go to zero. Certain parts of your portfolios will go to zero. If you look at the success rates of SME businesses or the amount of SME businesses that actually fold in Australia or around the world, in Australia in particular, is a pretty high percentage, right? We're talking about like 80, 90%. So, it is not unusual for a business that you invest in to go to zero, a part of your portfolio go to zero. And I think that people just need to understand that, which is why we believe that venture capital has to be done as a portfolio. It can't be done as SPVs, right? And then you will always kind of have a number of your, maybe a small percentage of your portfolio that becomes outliers that will return your fund. The way that we look at investing is every time we make a first investment into a new portfolio company, we take the view of, do we have conviction that this investment could potentially return our entire fund? Can it basically, so let's just say our fund was a $75 million fund. We have to take the view that we'd be able to build a position in this portfolio where it can ultimately deliver me $75 million of return, as an example. If it's a $20 million fund, then can this portfolio company deliver me $20 million of return? And I'm going to make sure I do 3 of those. That is very different to actually how some of the guys in the larger markets will play, which would be, if I was in the US, I might say, I want 5% of my portfolio companies to do 100x. Yeah. And I want 15% of my portfolio to do 10x as a seed stage investor. And that is the way that I can deliver my 4 times return on my on multiple on investor capital. And that's palatable in the US, where you've got billion-dollar outcomes that happen every year. You have 10 billion plus outcomes happening every year. And if you were one of the best in the US, that is what you should probably be shooting for. In Australia, while we've kind of been, I think I mentioned this before, while we've been efficient in the way that we've invested and we've delivered more unicorns per $1 billion invested than any other region, the absolute number of unicorns that's come out of Australia is pretty low compared to the rest of the world. Which means that from our perspective is we want to be able to make sure that we can return our fund at least 1 times with the portfolio company not having to reach $1 billion outcome. We just assume that doesn't happen, but it doesn't mean that we don't have conviction that it can happen. But we don't want it to rely on that for it to be able to return our fund.
So what's been the past what's been the past returns in the fund you mentioned, and what's if you got a new strategy currently happening? So what if a client goes into this, how long they're looking to hold in this strategy, and what's the expected return?
Yeah, so when we did the SPVs at the beginning, which we've stopped doing in 2015, on average across all of them, it's been about 3 times multiple in investor capital.
Over what period of time?
So the first investment we made in that was 2013, and then the last investment we made in those SPVs were probably 2015. The 2013 one, we fully exited. So we exited partially along the way, but fully exited in 2023. But we made exits along the way as well. So that portfolio is fully gone. Our 2017, 2018 vintage, it's about 3 times multiple on investor capital. So we did our final close on that in 2018. So it's coming. So we're now in our 8th year. We've returned about 35% of 0.35 DPI, or 35% of called capital today. We expect that to increase because there's an earn out from an exit that we've done to come through. So called that, we expect that to get to about 0.45, 0.5 over the next sort of few months. And then on our most recent fund, which is our 2022 vintage, that it's still pretty too early to tell. So that's just sitting at 1 times at the moment. Partly because, and I'm mentioning before, while we did our first investment in 2020, we actually did our final close in first close in 2020. We actually didn't do a lot of investments between 2020 to early first half of 2022, purely because we just didn't feel like the market was there was asymmetric return opportunities during that period because valuations were getting frothy, etc. So most of our investments were actually done in the last 24 months. So on a weighted average basis, it's been 2.5 years, and hence a lot of the portfolio companies haven't re-rated. So that's sitting at about 1 times.
So can you give a couple of examples? Now we're into the fun part, the deals and the transactions, right? So in the This is okay. The only thing I find hard with, right, is I get it. You know, you invest this strategy, you invest the asset class, and I do completely agree, mate. Ex stockbroker that used to do a whole bunch of mining IPOs and such, right? Completely get it, right? That you're better off as an asset allocator when you're dealing with lots of money. You know, allocating a portion to a good manager, you know, that can do a spread, right? I'm all for that, right? But the only thing I find a touch challenging is when you know, we're saying we were telling the client, "Hey, let's invest in a private equity transaction." It's like, "What's the private equity transaction?" No idea. When's it going to land? Not sure. But this strategy is great, right? So I get that question quite a bit, right? So I suppose maybe the only way to kind of cover that is in the most recent vintage. What are some of the businesses that you've gone into and why?
Okay. So I don't think this is a secret, but we honestly believe that we're going through a new technological cycle with AI at the moment. We've been watching this space for the last 3 years. Um, and actually, for the first 18 months, we felt like it was a space that it was almost impossible to invest in because everything that came out since the launch of the release of the first LLM by ChatGPT or by OpenAI was basically just people innovating around UXs or user experiences or sort of the user interfaces that's wrapped around the large language models. One thing that we always look for is basically going back to first principles, which is what is the problem that you're solving, right? Why are you solving it? Should it be solved? And then you're solving in a way which has material impact that people are willing to pay for over time. And we just didn't see that with any of the businesses that came out that were basically ChatGPT wrappers. And but we do believe that AI is going to agentic AI is going to solve a lot of industry problems. And it's almost like what we were seeing with SaaS 10 years ago. We think that's where we are with AI now, which is there's still a lot of problems and a lot of industry that hasn't actually been automated with AI, which can be and will benefit from it. So, one of those investments that we've done, which actually is a good example to this, it's a business called Haast. So Haast is a compliance AI business. Yeah. So, for yourself, you'll probably understand it given you're in the financial services space. But if you think about highly regulated businesses, especially consumer businesses, whereby, the content that you release is highly regulated in the sense that, you need to make sure you're not misleading. You need to make sure you're not greenwashing, all these kind of stuff. So what happens is in the organization, like for example, a large telco to a large financial service business to an insurance company, what happens is, they would have a piece of digital content that was going to get released. Before it gets released, it goes through a bunch of compliance checks, legal, marketing, compliance, etc. But what happens is once it gets released, no one's actually really monitoring that content, whether it's a blog post to a video to a LinkedIn post to a web page, etc. And the way that it used to be managed, or the way that the status quo is, businesses will either be reactive, meaning that someone has found something or noticed something, or maybe they even been tapped on the shoulder by ASIC, right? And they go, "Oh, we've said something here. It seems misleading. We'll fix that, and maybe we'll look around it." Yeah. Or they might be proactive. If you're large enough, like a Telstra or something, you might be proactive. And you'll go, I might hire external law firm, or maybe I have a small internal team that does spot checks, right? But your obligation to be not misleading or your obligation to not greenwash is not spot checks. It's just 100% coverage. But it is almost impossible. Well, it is impossible to be 100% coverage when you're a business like Telstra, where you've got maybe hundreds of thousands or millions of pieces of digital content out there. The other issue is your digital content is not just written content. You could have audio, you could have video. It could be a image where there's text within that image that's formatted as an image, where it's got a misleading statement in it, or it could be, 5 seconds within a 3-minute video that you've said something that could be greenwashing, right? So it's actually almost impossible to manage this properly. and have 100% coverage.
Is it true as well that even like, say you have a license and you're an advisor in whatever capacity, if you're on social media and you make a comment, that can be potentially even a breach?
Yeah. So I mean,
Is that accurate? Like I'm just so this software you're discussing can potentially canvas all of it and just quickly flag if there's something that may be a breach and needs to be fixed. Is that in a nutshell?
that's basically it. So basically, using its platform will allow it to basically screen everything that's live, right? But what it does as well is, and this is the power. This is also the other part of the power of AI that they're embedding into their platform. It's you as the user, maybe you're a large telco, you can then you can feed it your rules and policies um, into the platform, but the platform will also suck in, things like legislations, regulations, etc. And then it'll process it to basically formulate or come up with these rules that you can ingest into the platform. And what these rules do is they basically bring back anything that they think is potentially non-compliant. You as the user can then maybe go, here's low risk, medium risk, high risk, etc. And if it needs to be fixed, you can go into a workflow to fix it. And that's kind of the basis of the platform. But then the second part of the second stage of their platform or phase of their platform, which they kind of already in the process of doing, is they then build AI agents whereby it will work with the user to basically fix some of these problems with the user. And at some point, when users become comfortable and trust AI, technically that AI agent can go off and fix it alone, right? So basically, you identify this is a problem, and then the AI will go and fix it. Like that is ultimately the goal. But I think there is a barrier between enterprise customers willing to do that, at least in the early stages. The platform also then trains a model for every single customer, such that the model will learn about the customer and become more hyper personalized. So a perfect example is, you might be a large telco and you have a very low risk tolerance because it's such a large business. But then and then another user might be a little suburban telco that don't really care as much, right? So what the model does is it learns about you using the platform and then learns about you and your risk tolerance, right? And other factors, but risk tolerance. And so as to basically be more meaningful in the way that it produces you results to the platform. And that ultimately, we believe, is what will create the defensibility with a lot of these businesses, which is the personalized data that it gets fed through over the time. Because, if they ever wanted to basically move to a different platform in the future, like they will lose a lot of that data. They'll, in terms of the model understanding who you are. I mean, it happens now. Like, I don't know if you use ChatGPT.
Yeah.
My wife and I used to use the same account, and I'm pretty sure ChatGPT probably thought we were bipolar because we were asked questions completely opposites, right? And then eventually she decided, actually, I'm going to get my own ChatGPT account because it just worked so much better because it started understanding who I am as a person and the responses and results, which is just so much more tailored to me, right? Than when we were sharing the same account. And that's like a perfect example of like how that stickiness will happen.
And the machine learning capabilities that are starting to happen with AI. It's fascinating. One thing I wouldn't mind you covering, because I was chatting with the other colleague, when you're looking at this particular space, how hard is it to find a legitimate, company that is an AI, service company instead of just a legacy business that tried to just tack on something with AI and then, come across as, hey, we're AI, when they're just not?
I would say that there is a lot of, how do I put it? There's a lot of AI fairy dust out there, where a lot of businesses kind of, I guess, image or um, uh, facade themselves as an AI business, but they're not really, right? And kind of claim about automation that they don't really do. I think that's always going to happen, and you really just have to look under the hood as to what it is. I think there's two things though to your question. One is who's kind of have a better right to win in this space, right? Is it the incumbents or is it the AI native businesses? On one hand, we think there's pros and cons on both sides. On one hand, the incumbents are the ones that have a lot of probably the proprietary data about the existing customers, right? Which I think is very, very useful if they're able to leverage of it. But at the same time, because AI has created a new baseline, what we've seen is a lot of the AI native businesses, basically, and what I mean by AI native businesses is basically AI businesses that built ground up thinking AI first, as opposed to software and then going into and SaaS then enabling AI. And these AI native businesses are able to move a lot faster because they don't have the handcuffs of traditional thinking. They don't have the legacy tech systems that they have to consider in terms of building out their AI platform. And what that means is that we're definitely seeing a lot faster speed in these AI native businesses than we do in incumbents. But I think if the AI incumbents can actually move quickly, they actually have a competitive advantage with the data that they've got a lot
I
of the time.
100% agree with that. So one particular space I'm quite familiar with is, financial advice, CRMs. There's a number of competitors in the market. Everyone knows them. You've got Xplan, you've got a whole bunch of people coming through. But one particular way of maybe for people to think about this is it's scalability, making something more efficient and actually legitimately solving a problem, right? So one thing with an advisor like yourself, we have these meetings. If you don't record it, right, or you're not writing notes, how can you trust an advisor giving you advice if they haven't taken notes, right?
Yeah.
But the other problem is, how can you trust someone to physically sit there, write everything out and be engaged to solve a problem if their entire thing is note taking and they're not actually listening to what the hell you're talking about, right?
Yeah.
So the one thing we're seeing now, which is coming out of the UK, we're using Teleflow. They're bringing out a thing in 12 months where you can audio record your meeting and then essentially it'll pull all the information. You take the audio file, drop it into the system, and it'll pull everything from the transcript and the audio and then systematically place all that information inside their software as a service into their CRM, right? And automate it through, which will save an advisor like 4 hours from a day. And then, and to your point about compliance and regs, right? They've got compliance and regulation feeding into the software. And then you can pull the audio file and all that information, and then it all feeds directly into the advice related documents. So if I'm understanding you correctly, that business and the business you mentioned before is a phenomenal example of what you're looking for as an AI business. Is that something that would fit in the type of businesses you're targeting?
Yeah, I mean, that could be an example. I think that if I was to summarize it, we are looking for businesses. It's not about AI. It's about, again, first principles, which is what is the problem that they're solving
Yeah, okay.
in that industry that's meaningful, right? And then it's ultimately, should they solve? Does it need to be solved? Is it a real problem that people care about? And then it's the way that it's been solved. Maybe it's AI that it's allowing them to solve the problem in a way which is a 10 times impact. Or maybe it's until AI came along, they couldn't solve the problem in the past. Like the company I was talking about, Haast, it was, like I said, it was impossible for anyone to actually have 100% coverage of making sure that the digital content is compliant. Now they can. And that's through the power of AI.
Actually,
Right?
just on the just thinking about it then on the costs alone, like they would have just from a business perspective, how many people would you have had to hire to cover and look after all that stuff? Like, okay, let's talk about a real example, right? In the Biden administration with that Biden election and Trump lost, they lent on the major social media platforms and has said you need to stop, and quite rightly so, you need to stop bigoted speech, child sex offenses, all these horrible dark things that can exist, on social media, right? But in doing so, the human problem is human beings are human beings, and if you have a large number of people in an organization like Twitter at the time that vote one way, and then when they're in their hiring policy, people try to hire people like themselves. Unfortunately, you get skewed too far one way, too far the other. What ended up occurring was normal business operators that had an opinion ended up getting banned and their entire businesses shut down, right? It,
Yep.
it just it didn't work. There was a certain human bias to it. The other problem is they can't oversee it, and the cost, right? Of I think when Musk bought Twitter, didn't he fire like 80% of they're just not required anymore? So are you
Yeah.
saying as well from solving a problem on a scalability standpoint, this particular it's Husk, isn't it?
Haast.
Husk.
Haast. Haast.
Haast, Hast. Yeah, okay. So Haast can potentially, like a company now like X, you can give it parameters with the regulation and legitimately sift through it in an unbiased format and go, what is actually legitimately dangerous and shouldn't be there? And then, what is potentially an opinion and we won't kill that person's business, which happened quite a lot during COVID. It destroyed families.
Yes, I mean technically that you can apply to a use case like that. I think though, but to your point before, like the number one thing that we are basic. So when we kind of go when this business kind of goes into a proof of concept with a customer, like there's one metric that they're trying to prove in terms of proving value. In the past, when we first looked at this, we thought it has to be the amount of risk that you're reducing in the business, but it actually is not, because it's them trying to reduce risk is an ever going thing. Like no one wants risk, right? And they're trying to reduce this compliance risk all the time, and they're already doing it. What the immediate real value that you can actually demonstrate and quantify is on your return on investment is how much cost you can save, how many people you're going to how many costs in terms of external people you're going to reduce in terms of hiring like an external law firm to do this stuff, um, and then comparing to, well, if I wanted to increase my coverage from, let's just say they were doing 5% to 10%, I couldn't do it before because it means I had to double my budget. Actually, now you don't, right? You can
Yeah.
do the double amount, but with the same budget of less. So at the end of the day, especially in this macro environment, like the easiest way to prove value to a customer at the moment is how much cost it can save you and still delivering, if not the same or more value or more value to the business.
Wow. So with a client that Haast has, I don't know if you know any numbers off the top of your head. Like, is there a client which they have that comes to mind that the actual percentage saving, like the cost that they've saved this particular client?
Yeah. So in one particular case, at first instance, I think they saved them about 60%.
60%. And the coverage, as you mentioned before, like you may have only been seeing 5 or 10 or 15% of the flow, and now they're seeing pretty much as they can.
Mm-hmm.
So the exposure's gone up, the scalability's gone up, the efficiency's improved, and they've saved 60% of the cost, which can be redirected somewhere else.
Yeah.
That's cool.
That's cool, right?
That's really cool. So, just conscious of time, is there another business that you're currently looking at in the space, or?
Look, we're just about to make another investment, and it's slightly different. It's not in the vertical AI, vertical AI SaaS enabled space. It is in actually the large language model space. So one thesis we have is, there's obviously a LLM war that's happening in the US at the moment. And it's probably a war that we don't want to get involved in because I just don't think we have enough capital in Australia to basically participate, so to speak, especially us in terms of our fund size. But where we think is interesting is actually not the general LLM, but the specialized LLMs, where there's certain LLMs which are trained for a specific industry, right? Whereby it's actually lower cost to actually train that model. It's more accurate than the general models generally, or it can be. And it understands and has better output for the users. And one business that that we're looking at and investing in is a business called ESVCLP, which basically has built a specialized LLM in the legal industry. So what they're not trying to do at first instance is they're not trying to be the next Harvey AI. What they're trying to be is actually a model that Harvey AI can plug into, right? And especially where everyone is now moving to multi-models as opposed to single models, and there's actually very little there's very little cost in actually moving models. So the idea is that by providing them with a more accurate model, we're competing against the more general models, and we can basically plug straight into a lot of these plays. But that's another space that we're looking at.
So the legal one I love. Like let's be honest, ChatGPT, anyone else out there that does contracts, right, or even just normal people, you plug the thing into ChatGPT, but sometimes it spits out something. If you don't, sorry, how do I say this? If you don't teach it correctly and feed it the correct legislation, then what you'll get out is not necessarily what you want. So when I heard this was happening, I'm like, this is genius. This is magnificent. Why isn't everyone using it? But then when I spoke to a lot of my friends that are lawyers, their main concern was privacy, right? So how does this company deal with a privacy standpoint? If you're dealing with, I don't know, a major acquisition, right? And you've signed NDA agreements, and
Yeah.
and essentially you need an AI, a large language model, to plug in to make your life easier and go, okay, what am I missing? What clause has been pulled out? Save my ass, please. I've got a 3-hour deadline to get this thing done. The client requires it. I don't want to stay up till 2 a.m. in the morning, right? What protections do the users have? On that side, and where are my thoughts on this is kind of like something like Snapchat, right? Everyone says Snapchat's fantastic. Don't worry about it. The messages vanish. It's great. Fast forward a number of years, there's a data bank in some, dam somewhere that's just collecting everyone's data. Or like Ashley Madison, is another great example. Your data will never come out. Someone does a hack, everything's there, and then all of a sudden, from a legal standpoint, back to the contracts, you're in a whole world of trouble, right?
Yep.
So how have they gotten around that particular problem?
Because they are their own model, right? They are actually and they've built it, and because it's a specialized model, they have. So as a user, as a customer, you can run that model within your own environment.
Oh, right. So it's siloed.
Yeah.
So it's on its own server. So it uses the language model. Everything's there as the tool, but you can plug in and purchase your own server. And then everything's essentially in your own server bank, so it's not public. It's not a private server.
Technically, but basically you can run it in your own environment, and it can be on-prem or it could be off-prem, but like still within your environment.
Yeah, that makes so much sense. This has been brilliant. We can talk all afternoon. But Eric, is there any questions that you normally get from, investors or, large family offices that you'd like to cover that we haven't touched on?
Look, I think that we're just generally in a market where, capital raising for funds has been very difficult. And one of the questions that investors always ask is, what do I want to allocate into venture capital today, right? And I think it's one of those ones where, unfortunately, for an industry that's relatively nascent, a lot of the managers that they've invested in or the funds that they've invested in haven't gone through full cycles, or where they probably haven't created enough liquidity for them to demonstrate DPI performance and only TVPI performance. But what I would say is, regardless of what you've invested anywhere else or with the managers that you have and sort of what the outcome you've had today, one thing that is undeniable is venture capital is cyclical, right? And we are at the beginning of a new cycle, and we can see that from the balance valuations that's in the market. We're also compounding that with this AI technological platform shift that's happening, which, again, I was saying before, it's like what we were seeing SaaS 10 years ago, but it's now with AI, and valuations what SaaS was 10 years ago, but in AI, right? And we think that if you miss, because venture capital is so cyclical, that if you the risk of missing a vintage in the next few years, you basically run the risk of missing the asymmetric return opportunities in this space, right? It's an exposure in AI. Now, I think it's a lot of the time it's logical, it's easy to say, and people can appreciate it, but it's always hard to do, right? I think the reality is, generally when when no one wants to invest is always the best time to invest. If you want to just have an overlay of like a general rule, right? And I think that's what's happening with VC.
Yeah, it's been a bit of a crypto winter the past 3 years. This whole companies want to stay private for longer routine. I think we've had the lowest numbers of IPOs on the Australian market for a long time. The other thing as well, the IPO market's been very challenging because 10 years ago when things list, the percentage of things listing at a premium or a profit was higher. These days, things list and they just sink kind of nearly immediately. It's been quite challenging. So, but again, it's all cyclical, right?
Yep, that's right.
Hopefully the boom times are coming back.
Well, hopefully the boom time's not coming back too soon because we want to get our positions set before then.
Yeah, let's get set first and then let the boom time rip. All right, well, thank you very much, Eric. If anyone wants to, find you or get more information about Aura Group, how can they find you?
Always send me an email, eric.chen@aura.co, or just LinkedIn me.
Perfect. All right, Eric, thank you very much for coming on the Rate of Change with York Wealth Management. Have a great day.
Awesome. Ciao, mate. It's been a pleasure.
The Rate of Change podcast is presented by its speakers. The views and opinions expressed in this podcast are those of the speaker in their personal capacity and do not represent the views of York Wealth Management Proprietary Limited, its shareholders, directors, or any other third party. Any discussion of financial products, investments, credit, or property opportunities in this podcast is provided strictly for general information and discussion purposes only. Nothing in this podcast constitutes general advice, personal advice, financial product advice, credit advice, or a recommendation. Before making any financial or investment decisions, you should seek advice from a licensed professional who will consider your objectives, financial situation, and needs. Australian listeners can obtain further information about choosing a financial advisor by visiting www.moneysmart.gov.au. For clarity, the Rate of Change podcast is a business owned and operated by Murdoch Venture Capital Proprietary Limited. Any client relationship or referral that arises through the Rate of Change in connection with services outside the scope of financial services requiring an Australian financial services licence, including, without limitation, private credit, property development, or other non-AFSL activities, shall remain the sole property of the Rate of Change. Where listeners wish to obtain advice in relation to their investments or other matters that fall within the scope of financial services requiring an AFSL, the Rate of Change may refer them to York Wealth Management Proprietary Limited. York Wealth Management is referenced in this podcast solely in its capacity as sponsor. References in the introduction to the Rate of Change with York Wealth Management are sponsorship acknowledgements only and do not imply ownership or control of this podcast by York Wealth Management. To learn more about York Wealth Management as sponsor, please visit www.yorkwealth.com.au.